if AI could build you the perfect ETF portfolio? No emotions, no biases, just pure data-driven investing. Sounds amazing, right? But can AI really do better than a human investor? I asked AI to create the ultimate ETF portfolio, one that maximizes returns, minimizes risk, and beats the market over the long run. The results were pretty exciting, but let's start from the beginning. 3 days ago, I sat down in front of my computer with one idea in mind, seeing if AI can be a better investor than me and do my dirty work in my stead. So with my best companion ChatGPT in front of me, I gave him a simple but tough challenge. Build me the perfect ETF portfolio. One that balances growth, risk, and diversification while aiming to outperform the market. And I didn't just let AI pick random ETFs, I set some strict rules. It must use only ETFs, no individual stocks, it has to justify every ETF it picks based on data, it must optimize for long-term growth, not short-term hype, and will compare its picks to real-world portfolio to see if they hold up. Obviously, AI isn't perfect. When you use AI, it builds portfolios based on historical data and probabilities, and probably researches based on internet content. But it doesn't have experience or foresight like a human investor. It's purely data-driven, which can be good or bad. Another thing is that AI picks ETFs based on past performance, but doesn't consider real-world risks. It doesn't really feel market crashes, recessions, or investor emotions. So I didn't expect AI to tell me something like, look, now that Trump has been elected, there might be this or that in the future. So what did AI actually pick? And more importantly, does it make sense at all? Let's break it down. The first reply from ChatGPT was quite long and already quite detailed. First up, it picked VTI, the Vanguard Total Stock Market ETF, as a core holding. Well done, ChatGPT, 10 out of 10. Historically, US equities have been crushing it compared to other global markets. VTI delivered 17.42% in the last 12 months and an average of 16% in the last 5 and 12.3% in the last 10. Weighted according to ChatGPT, 35%. Data justification, US equities have historically outperformed most global markets, and broad exposure reduces the risk of sector and size bias. This is true. For example, the S&P 500 is focused on large cap, while with VTI you're getting exposure to the entire US stock market, which includes small, mid, and large cap stocks across every sector. So you do reduce the risk of overconcentration. And look, you're often going to hear that some Asian stocks or some other international markets have outperformed at some point, but that has never happened over the long term and with broad markets. Anyway, if you come from Europe, an alternative would be the Vanguard S&P 500 ETF, with the ISIN code here that you can get posting this video. As a second ETF, ChatGPT picked VEU, the Vanguard FTSE All World ex-US ETF, with 20% weighting. Again, I like this choice. Well done. In my videos, when I talk about international ETFs, I mention either VEU, this ETF, or VXUS, the Vanguard Total International Stock ETF. They are both great choices that include both developed and emerging markets. The difference between VEU and VXUS is that VEU is focused on large cap and VXUS also includes mid and small cap. So if you want to follow the line we started with the core ETF, here we should actually go for VXUS to get the whole international market as a whole. And if you invest from Europe, you can go for VWCE, the Invesco FTSE All World UCITS ETF accumulated. And since this ETF includes also the US, by buying this ETF, you basically get the first two ETFs of this portfolio all in one. So a third ETF that ChatGPT gives me is a small cap ETF, the iShares Russell 2000 ETF, IWM. I have to say, I don't really understand the choice. It already gave me the total stock market as a core portfolio, and VTI already contains 95% of all the holdings of this ETF. So it doesn't really make much sense to me. If you buy the S&P 500 as first position, then it would make sense, but not with the total stock market. Then we have BND for the bonds with 15% and VNQ for real estate with 10%. Now, bonds are useful only if you're close to retirement, because in the long term, they always deliver lower returns than equities, so they only serve the purpose of stabilizing your portfolio, not to increase the returns. So in my opinion, buy them only when you're getting closer to retirement, otherwise you're capping your returns. As for real estate, this is a strategy that I never really used, but I have to say that diversifying with REITs or real estate investment trusts might be a good idea. It has to be said though that real estate has had the greatest last 15 years, which makes me think that the next 15 years are not going to be so glorious, but you never know. The last ETF is EEM, the iShares MSCI Emerging Markets ETF, to gain exposure to emerging markets. Man, ChatGPT, sometimes you're really stupid. My friend, why would you give me an emerging markets ETF if you already gave me VU, the Vanguard's FTSE All World? And also, why did you give me the small cap ETF if you gave me VTI as a core position that already includes small cap? Oh, you see, makes mistakes, but at least it's humble. It basically says that I'm right and we should drop the two ETFs that I criticized, and the new revised portfolio now looks like this. 40% VTI for the US equity, 25% VU for international, 20% BND for bonds, 10% VNQ for real estate, and here, out of nowhere, it adds me VTIP, or similar cash equivalents, with 5%. This is something I often see from ChatGPT. You ask for a correction, and then it not only changes what you asked, but it also changes other things as well. Okay, ChatGPT, let's just confuse everyone. Anyway, VTIP is the Vanguard Short-Term Inflation Protected Securities ETF, which is a mix of short-term bonds, and you can use it as an alternative to normal cash. What I always suggest is to have at least cash equal to 3 to 6 months worth of living expenses to cover any emergency. Other than that, saving cash to wait for a market crash is about as useless as holding an open umbrella waiting for a rainy day. Except if you're Warren Buffett, that accumulates over $300 billion in cash and short-term obligations because he's getting ready to go on a spending spree. So the portfolio from ChatGPT is alright, quite diversified, but kind of boring. Before spicing it up and asking some questions though, let's see what AI said about performance. So, why this portfolio outperforms? 3 things. Growth, because of inclusion of small cap and emerging markets, diversification because of international equities and real estate, and long-term focus. Now, I do agree that small cap have delivered better results than large cap over the long term, but it might not be the same in the future. I feel that the global tendency is large companies acquiring more and more smaller companies as they grow, so this would bring large companies to create a kind of a monopoly in the market and always growing more than the small markets. By the way, let me know what you think about it in the comment section below. As for performance, US equities have returned about 10% per year. True, emerging markets have delivered higher returns than US equities during periods of global growth. Now, this is interesting and there is some truth in it. If you take the returns of 2023, the US returned 26%, developed market ex-US 18.2%, and emerging markets only 9.9%. But take the long-term return from 2001 to 2023 and you see that emerging markets with 7.6% return gain almost like the US and much better than developed markets ex-US. In fact, this is mostly due to the great growth of emerging markets between 2001 and 2005, while the US and developed markets were going down the drain. Small cap stocks have outperformed large cap stocks. This is true, as I said, if you consider the last 30 years, but we don't know what the future offers. And last, bonds that yield 4-5% on average, and they're there for stability and not growth. Alright, we've seen the portfolio ChatGPT build. Solid picks, although we haven't seen good growth or value ETFs like QQQ and SHD, but I'm not going to let AI off the hook that easily. So let's ask some interesting questions and see what it comes up with. Would you change this portfolio based on what's happening in the world right now? Notice that I'm not revealing what's happening. I want AI to think for itself. But obviously we have inflation, interest rates, the Ukrainian war and the conflicts in the Middle East. We have the new US administration. Let's see what it says. So, key factors driving portfolio adjustment 2024-2025. Interest rate inflation, with the Fed holding high interest rates for longer, US versus international, and yes, here it recognizes that US is overvalued and emerging markets are undervalued. True. Geopolitical risks, China, Taiwan, Russia, Ukraine, Middle East, AI and tech boom, and real estate pressure. Alright, the suggestions are Schwab US Broad Market ETF, SCHB, or Vanguard Total Stock Market ETF, VTI, for the core position. Here it says SCHB instead of VTI for a higher tech large cap exposure. This is true, but I'm not sure I change VTI with anything else except VO. Next, international stocks with iShares MSCI All Country ex-US ETF, ACWX. This is like VU but with more weight on emerging markets. This, I have to admit, might be a really good idea. I'm also fond of emerging markets, and given the terrible performance they had in the last 10 years, I expect them to overperform in the next decade. Then short-term bonds, and here I have to say, I don't really like bonds. And alternative assets with IGF instead of VNQ. Why? Infrastructure, roads, utilities, data centers benefit from government spending and is less rate sensitive than traditional REITs. Lastly, it mentions gold, and I have to say I always underestimated gold, but it had quite a performance in the last 10 years. Imagine that if you invested $100 in gold and in the S&P 500 index in 2000, 20 years later, you'd have around 50% more with gold than with the S&P 500. It has to be said though that 2000 was right at the beginning of the dot-com bubble, and if we take the time frame from 1990 to 2020, so 30 years, gold increases instead 360% compared to the Dow Jones Industrial Average, 991% gain, and this shows how stocks generally provide better long-term returns. So, next question. If the market crashed tomorrow, what would you do with this portfolio and what other sectors or ETFs would you buy? Not all crashes are the same, sure. Let's see the tactical moves. Rebalance portfolio. Shift weight back to target allocation. Some assets will fall more than others. Now this is what I often say when I say that if a crash comes, tech is going to crash more than value because it's overvalued now. So I'm probably going to buy more tech and growth than value. By the way, I'm going to do this regardless of my target allocation. I'm just going to do it because they're going to be cheaper. Increase equities. Okay, obviously. Buy growth and tech ETFs if rate fears cool, increase QQQ and VGT if oversold. Alright, this is what I said before, and by the way, QQQ and VGT would be exactly my choices. Defensive plays, buy low volatility ETFs because they hold better during crashes. This is not something I would do. I always think long term, so when I buy during a crash, I buy something undervalued that will also perform better in the long term future. And low volatility ETFs are not really it. Small cap stocks, more gold and tips and so on. Alright, let me ask another question. Briefly explain, how does this portfolio compare to what Warren Buffett or investors like Ray Dalio recommend? Buffett's philosophy is buy great US companies and hold forever. I love this. Really love this. What Buffett suggests to average investors, and to his wife by the way, is 90% S&P 500 and 10% short-term bonds. Now, the portfolio from ChatGPT is more diversified because of the total stock market, small caps, real estate and gold, more sector specific, and this is not necessarily good for me. And less concentrated on the S&P 500, which in my opinion is the best index ever and is enough for most people. Ray Dalio instead has a really varied all-weather portfolio, and his strong point is balancing risk across different economic conditions so that the portfolio is not the best performer, but it's stable in any economic situation. Now the last thing I want to ask is, if you had $10,000 to invest right now, how would you allocate it? Alright, VTI 40%, great choice. VXUS for international diversification, 20%, good choice. Alternatively, VU. Oh, QQQ. Finally, ChatGPT gives me QQQ, the best growth ETF ever. 15% to give you the greatest growth exposure you can wish for. Then AVUV, US small cap value, which had actually changed with the SCHD, and then gold ETF, which would be a good choice. Yeah, and then BSV for bonds. That I would change with BND, but only when you're close to retirement. Great, ChatGPT. Thanks for your help. Are you going to replace me as a finance YouTuber? It's not a joke, it's a serious question. I worry for my future. No way, Rick, you bring the personality, experience, and trust that no AI can replicate. I hope you're right, my friend. And you right in front of me. If you don't want to be the reason why a poor YouTuber like me ends up in the streets, subscribe to the channel and let's meet again next week. Have a great day, everyone. Ciao.